Hey there, and welcome. Today, we are going to pull back the curtain on a tool that sounds super intimidating, but is actually at the heart of almost every business decision, the financial model. We're going to break down what it is and walk through the 7 core ways it's used to make huge calls, from figuring out what a startup is worth to financing a brand new wind farm.
So when you hear financial model, you probably picture some crazy, complicated spreadsheet, right? But really, at its core, it's something way more powerful. It's a tool that lets you see the future. I know, that sounds like a pretty bold claim, but just stick with me and you'll see exactly what I mean.
Okay, so what is it really? The best way to think about it is like a business roadmap. It takes all the different moving parts of a company, its sales, its costs, its plans for growth, and it translates them all into a single, structured financial story. It's basically the bridge that connects a big idea to its financial reality.
And this right here is the main idea for our explainer today. A financial model is not a one-trick pony. Not at all. It's more like a Swiss Army knife for business. It's one single, compact tool, but it has all these different attachments, and each one is designed to solve a completely different problem.
So here's what's on deck. We're going to kick things off with valuation and fundraising. The big money stuff. Then we'll look at how it's used inside a company for strategy and operations. After that, we'll dive into major deals and projects. And finally, we'll wrap it all up by talking about picking the right tool for the job.
All right, let's open up that Swiss Army knife and look at our first set of tools. These are all about answering those huge money questions. How much is this company actually worth? And how do you convince someone to give you their money to help it grow?
First up, and this is probably the most common use you'll hear about, is valuation. Think about it. Whether you're an owner trying to sell your business or an investor looking to buy in, you absolutely need an objective answer to this one single critical question.
So how's it done? Well, one of the most common ways is with a method called a discounted cash flow, or DCF. This is where that seeing the future part really comes in. You project all the cash you think a company is going to generate in the future, and then you use a formula to figure out what all that future cash is worth in today's dollars. So if an investor hears a startup is valued at $10 million, they don't just nod their head. They build a DCF model to really kick the tires and see if that number actually makes sense.
All right, the next attachment on our knife is all about persuasion. Look, if you want to get a loan from a bank or get a venture capitalist excited about your company, you can't just walk in with a cool idea and a lot of passion. You need a rock-solid plan, and that plan has to speak the language they understand, the language of money.
And that's exactly what a financial model for raising capital does. It tells a story. It shows investors, hey, here's how your money is going to be the jet fuel for our growth. And, even more important, it says, and here's the clear, profitable path that shows how you're going to get that money back, plus a whole lot more. It transforms a founder's vision from just an idea into a concrete financial projection that an investor can actually sink their teeth into.
Okay, so now we're moving from talking to outsiders to looking inside the company. This is where the financial model acts like a kind of time machine, helping leaders test out the future and make smarter decisions every single day.
And that brings us to use number 3, strategic planning. A model lets you play out all these different what-if scenarios without any of the real-world risk. What if we raise our prices by 10%? What if we hire 5 new engineers? Instead of just guessing, you can actually model the financial impact of every decision and see which path leads to the best outcome.
Imagine you own a coffee shop. You could model 2 different futures. In one, you open a second location. In the other, you invest heavily in a new delivery app. By plugging in different numbers for things like rent or marketing costs for each scenario, the model can spit out which path is likely to be more profitable. It's all about making decisions with data, not just a gut feeling. Which leads us straight to our 4th use, the absolute bread and butter of corporate finance, budgeting and forecasting. Now, people mix these terms up all the time, but they're 2 different tools. Think of a budget as a detailed photo of your plan, taken once for the whole year ahead. A forecast, on the other hand, is more like a live video feed. It's a living document that's constantly being updated, giving you a real-time view of where you're headed.
Okay, so you've set your budget for the year. But what happens when things go off track? When reality doesn't quite match the plan? Well, that's where the 5th use comes in. The model becomes a diagnostic tool, like a detective, helping you figure out exactly why you missed your target.
This is what's called a variance analysis. So a manager might see that profit is down and immediately assume, oh no, our sales must have been terrible. But the model tells the real story. Check it out. Revenue is actually up. The model instantly pinpoints that the real culprit was shipping costs, which were 3 times higher than they'd planned. That is the kind of insight that helps you solve the right problem. All right, for our last section, we're zooming way out to look at the absolute biggest, most complex decisions a company can make. We're talking about the high-stakes bets where having a solid financial model isn't just a nice-to-have, it is absolutely essential.
Use number 6 is for mergers and acquisitions, or M&A. When one company is thinking about buying another, they build an incredibly detailed M&A model to answer one fundamental question. Will 1 + 1 equal more than 2? The big goal is to see if the deal will be accretive. That's a fancy word that just means, will it increase the combined company's earnings per share? The model is the crystal ball that tells them if this massive deal is going to create value or destroy it.
And that brings us to our 7th and final use, project finance. This is a super specialized type of modeling used for enormous, long-term infrastructure projects. We're talking about building new power plants, toll roads, airports, you name it. These are projects that cost billions of dollars and have to be planned out over decades to convince banks and governments to fund them.
Phew! So we've gone from valuing a tiny startup all the way to financing a huge power plant. What's the one big takeaway from all of this?
At the end of the day, a financial model isn't just one single thing. It's just like that Swiss Army knife. It's this foundational tool that you can adapt with all these different attachments: a DCF model for valuation, a budget, an M&A model, each one designed to answer a very specific and very critical business question. It all comes down to picking the right tool for the job.
So I'll leave you with a question to chew on. Thinking about your own business, your career, or even just an idea that's been bouncing around in your head, which of these 7 tools in this financial toolkit would you want to pick up and use first? Thanks for tuning in.